Ladies and gentlemen, that is what you call never late. 10 o'clock. Welcome to the SOFI Weekly. Okay, today, myself, Tevis below me, Mr. Blueberry over in the bottom left-hand corner, and Danny, the Un Poco Mas himself, deals. How's everybody doing?
Doing well. Happy Friday. Happy New Year.
Good stuff. Good stuff.
Hello and welcome.
How's the audio, by the way? Let me know if you guys can't hear me very well. I will get closer or something. So pretty bad week for SoFi. Anyone sell any shares?
No, I was buying about five. I told you I was going to buy 5,000. I bought more. I bought about 7,000 shares.
I think what you said was if you weren't coming on the podcast, you would buy 10,000 shares of SoFi.
If I didn't show up, yeah.
Yeah, and so instead you bought 7,000 and showed up.
I didn't know the price. I would have had to buy 17,000. And then I'd probably be thrown in jail by the IRS for not taking care of other obligations. So I had to show up.
Yeah. Tevis, what's your trading status like? Any SoFi for you?
No, I bought some Unity this week. I didn't buy SoFi just yet. I bought a ton of SoFi at like $10. I think I bought like 1,200 shares or something. I'll buy again. I'm not against it. I think even if we go higher, I'll buy again. It's not really a matter of like me just stockpiling cash on the side and then just like waiting for. It's like whenever I have cash in the account, whatever price it's at, like I'll just buy it.
Sure.
Yeah.
What about you, Steve? What did you get into?
I bought SoFi today. I mean, I don't think anybody should buy shares because one of us buys shares, and I certainly don't make my decisions on short reports or bear reports that I could care less about. I do my own due diligence. I know the risks, and whatever money I put in, I am willing to lose. I bought shares today, and I'm probably going to write some cash secured puts early next week. I'm looking at the option chain now. 28 cents at an $8 strike looks pretty interesting.
Yeah.
All my viewers do cash secured puts. All my viewers, that's all they talk about. That's their, of course, covered calls, but they're just everybody's infatuated right now with cash secured puts. So I think I think Steve moves the markets and YouTubers. I agree. The bear report, if you're selling or buying on these analysts, I mean, it's bad theater. It's bad theater. These calls are some of them are so kind of absurd and just out of nowhere. I mean, he's writing this over New Year's. I mean, it's just so odd. He was a hold on the stock at $18 2 years ago, and now he thinks it's worth 1/3 the money after the last two. It just doesn't make sense to me.
So let's baseline news that came out on Tuesday after the market around an analyst called Michael Perito of KBW downgraded SoFi to underperform with a $6.50 price target from $7.50. If you'll remember, probably not, because KBW is a pretty boutique firm, but they were the firm that the moment that SoFi crossed the $10 mark after Q2 earnings back in the beginning of August, they put a sell rating on the stock. Now, you could catch this both ways. On one hand, arguing that, wow, he timed the top. You could also say that he caused the top. Given the stock price reaction that we had this week, SoFi, I think year to date in 2024 is down something like 20% over the past 4 trading days because we weren't trading on Monday. It was New Year's Day. So the market really beat the stock down as a result of this analyst report. And quite frankly, there was nothing material in that analyst report, which I'm happy for us to dive into and talk a little bit more in depth. I think a large part of the shock factor was that this was a higher rated analyst. It wasn't the likes of Chiaverini's, half-star analysis This guy has a positive track record. And, my main criticism around that, without even getting into the points themselves, was just the pattern of this guy putting a sell rating whenever we hit a certain price and then flipping back to a buy rating whenever we hit another price when nothing really fundamentally has changed with the stock. That kind of trader mentality in general is nothing it's nothing admirable in an analyst, because analysts are not supposed to be traders. I get if something material changes with underlying company, like new earnings are released and the numbers are materially different, or the story changes, your bull thesis changes, I get that. But if you have let's say $10 price target today, and then tomorrow the stock climbs too fast, because this was one of the reasons, and hits $12, you're not going to put a sell rating on the stock just because, it's higher than your price target. Like, the stock price action in the short term is emotional. It's human psychology. It's erratic. It's irrational. And that should be no reason in isolation for any buy or sell rating for analysts. That's why the company fundamentals come out on a quarterly basis. And unfortunately, these analysts can reiterate as often as they want. They can change however often they want in between quarters when no new numbers have been released. So that's just a primer on that conversation.
Right. Yeah,
it's also very odd that it's almost like he's guiding swing traders. You don't usually see analysts kind of working in that channel and calling the top. I mean, that's sort of the danger in looking at those tip ranks, like star ratings, is, I mean, if you're just trying to call the channel like a swing trader, it's not super complicated, because if you make enough calls, it stays right in the channel. You call a hold. So I don't think what he's doing is really analysis as much as just kind of trying to call the top based on the chart. I mean, that's what it looks like. Everybody saw that 1160 was kind of crazy, so he slapped a sell rating on the stock that instant. I felt like he cooked this one up Thursday or Friday when the stock was at 1040, and then he just, got a little bit drunk on New Year's and, put it, whatever it was. But I felt like he was trying to call the top and he just slightly missed it, and this whole, attack was preloaded.
I know you say that tongue in cheek, Danny, but I think there is some method to that madness, because the executives of SoFi's team are very likely in a blackout period right now. Because we're so close to the Q4 earnings, the executives are subject to material non-public information. And as a result of that, they can't really make too many moves. Like, Noto can't come in and do an unscheduled buy of stock because it's essentially too close to earnings, and he knows something that the rest of the market doesn't know that has the potential to move the stock. And so when you're talking about the timing of this analyst, why didn't he release his note when we were at our peak last week of December? Like, why did he wait until the new year for us to be within a month of earnings to be released? And so, your mind starts racing with all of these different alternatives.
Well, and was that a spontaneous market reaction to this guy's $1? I mean, 90 million shares traded in an absolute frenzy. This just didn't feel like any type of these sell-offs don't feel organic. I mean, the call and the reaction, nothing about it feels like this is a natural reaction to Michael Pareto from KBW downgrading a stock $1. And then he tries to sell you that EBITDA is going to be up to 15% below. This is his rationale. I mean, Noto is always a little bit above the analysts, always guiding upward. And he's always coming in slightly above. He's always under promising and slightly over delivering. It's been one of the most consistent growth stories. And he's going to be wrong now by 15% based on some very thin, it goes back to the same thing Chiavarini was playing on, which is the accounting structure, how that could affect the value of the loans, how they're taking too much up front. But I'm no accountant, and you guys all know more about this than me, but I feel that if you're consistent in your accounting and you're honest in your accounting, some things will swing to the good for you. And then when that goes back, it'll swing to the bad, but it will all even out as a company. And that has nothing to do with the overall trend, performance, fundamentals, execution. It's just these marginal nitpicking issues that really don't seem to affect the company very much over the long term. It's like he's talking to swing traders, even day traders, shorts, his bosses, maybe his ex-wife. I don't know. I don't know who he's talking to, but
there's a couple things I want to just throw out there that we can chat about. One of them is
Can we touch on this before we move on? Because there's a lot here. So, one, I think that you're absolutely right. It did seem like the sell-off was completely different than reactions to really any other sell reports that I've seen, especially from not some really prestiged analyst, right? I thought that was really weird. A 14% sell-off on no new news. This was all information that was widely available to investors. The only thing that they said that was actually material is we changed the models on the way we look at the stock. But that doesn't mean that they're right. I don't necessarily think he's putting out sell reports at the tops. You know, like if he's able to call the tops of stocks, I don't think he should be an analyst. Maybe he should be a trader or something. You make a heck of a lot more money. So I don't believe in anyone's ability to continue to call the absolute peak. But yeah, I did think it was very weird. This is no new information. And a lot of the things that he said, he gave multiple points that contradicted each other. One was that originations would slow, and that would only slow in terms of management's sake if rates stood higher for longer. But then on the next breath, he would say that the fair value of the new loans that are coming in will decrease as the coupon rates are coming down for new loans to adjust for, competition for other personal loans, these sorts of things. So, okay, which one is which? Are rates going to go down or are rates going to go up? And you can't pick and choose the percentages of the company or products of the company that are going to do bad in certain interest rate environments without also acknowledging the products that do better whenever interest rates start dropping. Student loans, home loans, the tech platform, SOFI Invest, SOFI credit cards, all of these products that have historically not been doing well because rates have been climbing can absolutely flop the other way because they will be the shining products in the next, sort of macro shift.
And the credit card debt, record credit card debt's going to drive the personal loan demand, even with some rate cuts. I feel like. Sorry, Steve.
Yeah.
So I guess you want me to talk about the macro, since that's what you were alluding to.
No, I was alluding to maybe hearing your side, but if you want to go macro, Steve, I'm happy.
Well, how about we use one of your referrals for Koifin to bring up some data?
There you go.
All right. So they keep changing.
Link in the description.
The market keeps flip-flopping on what's going to happen. I mean, we looked at this on Cash Flow Chronicles last night, and it was 100% no rate cut in January. Let me share my screen. And lo and behold, 24 hours later, we're at a 6.2% chance of a rate cut in January again. We go into March. Wow, here we go. Okay, so the market is still pricing in a 25 bip cut by March. And you look at the end of the year, this scares me because not a lot of people believed what Jerome Powell said. They didn't believe the Fed minutes throughout all 2023. There were very few people that said this is not what the Fed is saying, and everybody is misinterpreting the information. We did not get a rate cut. If you go back to the minutes and you listen to it or you read it, Powell said the independent assessment that the Fed members did in September, the median was 4.6% for 2024, 3.6% for 2025, and 2.9% for 2026. What the market is pricing in right now, you have a 65% chance that rates are between 375 and 425 bips by the end of the year, with a 20% chance that they're anywhere from 3.25 to 375. I mean, that's an overwhelming amount of being under what they're telling us right now. And there's just not enough economic data to even get this far ahead of what the Fed is actually telling us, or without even getting more information from the January meeting. I mean, I'm getting worried about where they're saying that this is going to go. The only way that you get here, my opinion, is if a recession is occurring in the summer, and there's no data to support that. The number one indicator, forget the inverted yield curve, because that's not 100%. What is 100% is getting a 1% increase in unemployment, because that means that you're in a recession. It's happened every time over the past 5 or 6 decades. And the last report that we got, unemployment rate went down. So we need to see if it's an anomaly or not. But
yeah, but Steve, look, if rates go up, down, or in freaking circles, SoFi's business has been proven to be versatile enough that they have so many different product lines that can thrive in any rate environment. They thrived in 2018 when we had rate cuts. They thrived in 2020 when they lost student loans. They are thriving in 2023, put up one of their best years in a high rate environment. And so we know for a fact that they can. Sorry, go ahead.
If rates go down, it should be very good for the financial sector. Now, not rates going down to super low levels where they were, but if they come down a little bit, it should be very good, because there's going to be so much more activity on the buy side for products, for business loans, for mortgages, for purchasing equipment, for purchasing cars, that it'll be a volume game, and financials should do very good. I mean,
so tell me how this analyst thinks both are going to happen. That one, the new loans that we get on will be worth less, but also two, that originations will have to slow because we don't have enough room on the balance sheet. Well, if what Steven's saying, that there will be more activity on the buy side for loans because our existing book, right, Steven, will have a higher.
I'm making a generalization. I'm not saying just for SoFi. I'm making a generalization for financials.
Right. But that doesn't necessarily mean that SoFi's loans are not high quality. They're AAA. So
yeah,
if we're selling loans today, imagine what that happens whenever you can't go and get treasuries that are worth nearly as close to what SoFi's personal loans are worth. The larger the discrepancy, the more worth it'll be to buy SoFi's loans on secondary markets. And if they are able to sell loans, that means SoFi has more room available to sell more loans. Yeah, so both cannot be true, and that's what he put a $6.50 price target on.
And we need to expand on what Tanner just said, because he's 100% correct. And when you look at it as, when the Fed starts cutting rates, treasuries are going to go down in value. Look, the yield's going to go down. So let me rephrase this a little bit. The yield on new treasuries will go down. So the treasuries that have been issued will be worth more because they have a higher yield. And what is issued in that same period? Loans that have a higher yield. So when the rates get cut, it's going to push the value of those loans up, because they come with a higher coupon. They come with a higher yield. So SoFi will be in a position where they can probably make a larger spread on selling their loans that are still on the book. That is the big thing that they've proven that they can do already, but people seem to not believe them for some reason, even though it's in the numbers. It's just, I don't know. I'm not buying the bear case. I am buying what I believe is going to happen. And it doesn't shake my conviction one bit. I could be 100% wrong, but I'm certainly not a seller in this.
Yeah, I mean, look, I think it's very transparent with, 15 minutes of conversation to figure out that the numbers or the rationale is cherry picked, and that for every one of the negative points that he highlighted, there's obviously positive points that go alongside that in that type of environment for rates. Let's not forget that 10% below revenue estimates for 2024, below street consensus, which they've triple beat for the last 2 years in a row, consistently. and then 17% below EBITDA projections for 2024. If you do the math on that, this guy is like expecting like a 10% growth for SoFi in 2024. And that price target of 650, I think that's a full year 2024 price target. So it's just, once you put it into that lens, it's pretty ridiculous. I think one of the reasons why it had such a big impact on the stock was the fact that it got so much media coverage. It was covered in like 15 media outlets. Everybody was talking about it. Barron's, CNBC, Market Watch, Yahoo Finance, everybody covered it. And I mean, this is coming at a time where short interest is still at 14%.
May I offer a hypothesis that he's not trying to make a coherent argument that three people like yourselves couldn't easily pick apart just because you are knowledgeable on the subject matter? I would argue that he's trying to confuse and scare retail investors because he knows market makers are about to dump the stock the next day. And the argument doesn't have to make that much sense. As Tanner notes, it contradicts itself in a very fundamental, very obvious way that even I can understand. And I'm not an expert on the subject matter, but so many retail investors are so easily scared. He just needed to make fear and confusion that was amplified by all those headlines Tevis is talking about for 1 or 2 days. And by the time people like Steve, who get the message out, who actually know what they're talking about and explain this, the damage is done. They already pushed the stock down 20% in 4 days. So it's an absolute shock and awe. I just think, trying to actually make sense of what he's saying is maybe giving him too much credit. I know I see too many conspiracies, but I just don't think the argument is meant to hold up. I think it only has to hold up for a couple days, get all the headlines, damage is done, cover accumulate, skin retail alive, and just rinse and repeat. I mean, they've done this over and over and over. And
I think we're all used to negative news on SoFi. And I think the thing that people should always remember is that this is why you should always have cash on the sidelines. And this is why you should always leave yourself opportunities, because in the long term, if SoFi does what even half of what we think it has the potential to do, this is going to be a gift. I mean, I purchased today. Tevis purchased last week. Danny purchased yesterday or today. And look, just because we purchased, we could be 100% wrong. Do not do it just because we do. But, I saw it around 825 as an opportunity.
Yeah.
And if it goes into the sevens, I'm going to buy more. Like, I'm really considering writing cash secured puts at 8 because, okay, pay me to buy it at 8. And if I get 28 cents a share, think about it. 28 cents a share on $8 is 3.5%. Okay. So I'm going to make 3.5% on cash over a 2-week period if it never hits. You can't make 3.5% on cash anywhere. Okay. Then if it hits, I'm actually getting the shares at 772 because I'm getting paid that 28 cents. So it's just, I don't know. I look at this as an opportunity. And quite honestly, if you're a long-term investor like me, this is great. If you're a trader, this sucks.
Yeah.
But for me, I look at it very simply. Let it go to 6. I don't care. I'll buy more.
Yeah.
Like
if you're looking to add,
just whatever. Let it go back to 5. Let Noto step in and establish a new bottom. I'll be buying. Like, good, go to 5. Please go to 5 before earnings, and then after earnings, go up. Let me acquire more at a lower price. Yeah. Because what does it matter? It's a number on the screen.
And I think, Danny, just to your point, I think the reason why this is getting so much, even attention from us, quite frankly, is because you would expect this stuff from a one-star analyst where it's like this shady stuff that's going on, but there's reputational risk if you have a highly rated analyst pulling the same stunts.
What's the guy's name? I didn't even read.
The Perecito, Michael Perito. But the fact, I'm Tevis, what I would just warn against, because I have spent many a sleepless night going down the rabbit hole of tip ranks. And just those 5 stars does not mean the guy necessarily knows more than Dan Dolev at Mizuho, who's a 2-star analyst.
Yeah, absolutely.
Who I consider to be one of the most intelligent guys in the sector. How he got, maybe he made one wrong call, it drags your data set completely off, and maybe you could make 1 or 2 lucky calls and you have this number, but you have to dig a little bit deeper because I mean, KBW, Michael Perito, you guys are in this business and you don't even know who the guy is. Like half the people on my channel had never even heard of the analyst house.
All right, so let me say this.
And he causes a 20% drop. It's massive power.
I know a lot of people follow tip ranks. I personally don't, for the simple fact that, to my knowledge, and I could be wrong, but I'm pretty sure that I'm correct on this, it does not include total return. It doesn't include dividends. It only looks at the price, which is ridiculous because there are some companies that have a 5 or 6 or 7% yield where the average price could be down 2%, but the total return could be positive. So I just looked him up on there. He's number 961 out of 36,000 experts. Pretty good. 63% success rate, average return 14.9%, and he has a success rate of 134 out of 212. All right, I put my name in. Wait, and his rating is 4.79. And he does this for a living, and he probably picks and chooses very carefully what he puts out there to try to keep that rating up. I don't know the guy, but if I was doing it for a living, I would be very selective. I write about a ridiculous amount of stuff. Okay. I have a 59% success rate on here. And I know that this doesn't account for dividends. 246 out of 420 ratings. I write about what I like, which is a very broad spectrum. And my rating on here is 4.62%. Or 4.62 stars. I don't know what they use for an algorithm or whatnot, but I don't know.
I didn't realize we had a 5-star analyst on the show. I'm gonna start saying that.
Yeah, it's gonna change soon. I mean, it changes all the time, but it doesn't matter. None of this stuff matters. He's one person with an opinion. I'm one person with an opinion. You guys are one person each with an opinion. I mean, look, everybody's looking at different things. What ultimately matters is what happens in the long term. And people need to do their own due diligence. And while that is part of due diligence, people should be reading the 10Ks. They should be reading the 10Qs. And quite honestly, nobody should invest in anything that they don't understand. If you don't understand it, you shouldn't be allocating capital to it. Put your money in an index fund. You'll do much better and you'll save yourself headache.
Steven, what's your 12-month?
You're one person with an honest opinion. I think that's a very important distinction. When you write articles, they're packed with numbers, facts. These calls, I just don't think you can assume it's his honest opinion that this stock is worth 1/3 what he thought it was worth.
I mean, look, I never met the guy, don't know him, don't know any of these people, and don't know why they do what they do. All I know is that when I write something, it's because I have an interest in it. Yeah. I have a specific opinion about it. You look at PDI. I like corporate debt. Not a lot of people like corporate debt.
Yeah. And then Danny, if we follow that rabbit hole all the way down, there's only 2 conclusions. It's either bad analysis or bad intentions, and I don't know which one's worse. KBW on their website,
anything. Let's not even say it.
Yeah, but KBW on their website fully highlights disclosures for SoFi specifically. They're, I think, owned by a bank, Stifel, or at least in partnership with a bank. So, I mean, there's a ton of rabbit holes you can fall down. And fundamentally, it comes down to one of those 2 things. Either the arguments are weak in themselves or there's bad intentions at play. And that's true for any analyst.
And I don't know, he might have just changed his mind and be as honest as the day is long. All I'm trying to do is just look at the evidence of the calls he's made over time as the fundamentals and the progress of the company have been quite impressive to me. And does it make sense? You can just completely change your mind, and you can, they retooled the model, different inputs lead to different outputs. You change the equations. I mean, who am I to say, but I just think these calls, because they have such a huge effect on the market, should be treated like a material fact. Like, does everyone in his office know he's working on this call? Is he bouncing ideas off other people in other companies? Like, how many people know this call is imminent? Because I know he's not management. I know he doesn't know internal secrets of the company. But when you're talking about something that can move a stock this big and this state 20% in 4 days, it just seems like an outsized amount of power. And again, Steve is absolutely right. I cannot say there's anything, dishonest happening.
So let's talk about facts. The facts are that SOFI released when they are releasing Q4. Okay. What did they not release? Oh, they didn't release a revision. They didn't come out and warn that they're not going to be profitable. I would like to think, with everything that they have said for the past 3 quarters on the conference calls and on every fireside chat, if they were going to miss, and let's keep in mind, today is January 5th, 2024. The 2023 fiscal year is over. It is closed. They know what they did. Like, they know the numbers. There is nothing changing it. If they were going to miss, I hope to God they would have warned. Because
they have a history of doing that. They did that before. Whenever student loans got pushed, they revised.
Okay, but what I'm saying is, you have earnings in 2 weeks, and they came out and issued the date that they're going to release, and they haven't revised. Yeah. They haven't done anything. That makes me think that they're going to hit their key number of being net profitable. Because why wouldn't you take this opportunity to pre-warn? Okay.
Yeah. Just for everybody that hasn't heard the news, on Thursday, SOFI announced that their Q4 earnings call is going to be held on January 29th, which is Monday at 8 a.m. I think it is. It's pre-market.
Yeah. So
I hope all of you guys, by the way, in this panel can also join us. Steve, might be a little bit hard for you. It's a Monday.
We will be live streaming it.
Be hard, but the fact that they didn't warn makes me think that they are going to be profitable. And look, if nothing changes, this is all noise over the next couple of weeks. Anything can happen. But what's going to be more interesting is if they're profitable, and if they guide for a profitable year going forward, and they come out with a really nice projection, and the stock sells off again after earnings, then we got to revisit the investments thesis and be like, what is going on here? And what does the market see that we're not seeing?
Well,
that's what we need to look at.
To be fair to Michael, he did say in his projections that they are hitting profitability and going forward, sustaining profitability. And so he's not even stating that that's not going to happen.
One thing I'll say, just to add to your comment, Steve, with regards to the revision, I think them not issuing a revision increases our confidence of profitability. But don't forget that both Chris Lapointe and Anthony Noto had multiple appearances in December when the quarter was pretty much wrapped up, and they reconfirmed profitability with like 2 weeks left in the quarter. They wouldn't have done that if it wasn't already in the bag at that point.
Agreed. Yeah, I don't see it enough to get worried about right now because there's no new news. This report came out with no new news, and it came out in an environment where for the first time in 3 years, everything is going to be firing on all cylinders.
Yeah.
Like, I think that that's the thing that makes me step back. What is everybody seeing that is not bullish that I'm not seeing? Because this is a management team that had one hand tied behind their back, largest profit center taken away for them without any say, and they pivoted and they outperformed every quarter going forward, and they built every new product to diversify and lighten the load of that burden. And they did a hell of a job doing it. So what happens when they actually have a business that's all working together in all their business segments?
They guide for higher and try to beat that as well.
And everybody's ceding the student loan market to SOFI. Other people don't even want to be in the business anymore. And look at the credit scores of those customers. They're 30 points higher than even the personal loan customers. The incomes are higher. I mean, though, when you talk about the super premium loan market, it's like those are people with advanced degrees, PhDs, medical doctors. They're going to be taking big mortgages. Those are going to be extremely profitable customers if we hang on to them. I think people underestimate how important student loans will once again be to SoFi in terms of getting those ultra premium customers onto the wheel. I mean, that could be a real ace in the hole. And then I think people underestimate the Wyndham buy. I mean, that was probably a panic sell they got for a song on Wyndham.
That's a very good point. And I'll tell you,
the house segment is going to increase for SoFi, the mortgages side.
It's going to be a volume game. And look, if the Fed really does cut the way the market is predicting, the housing market's going to be on fire.
Yeah.
And each mortgage origination is a lot of money. It's thousands of dollars that the originator makes, even if they just lay it off. I mean, that's why those people call you, and they have you can make a lot of money originating home
their
loans.
Lowest profit segment, though, if I'm not mistaken.
Get home loans?
Yeah.
I thought
No,
home loans is
Are they
but
does
here
Wyndham hold the loans, or is Wyndham loaning their own money, or I don't know. I don't know that much about Wyndham, to tell you the truth.
No, so it's all just become SoFi Bank. But Wyndham Capital Mortgage, in terms of the home loans that we bring on through SoFi, they just sell them all off. We barely hold any home loans at all. Even if
the origination is the profit, holding them is
even if the gain on sale margin isn't that high, we don't even care. We just want to service our clients, make sure that they're happy, and then really, if in a perfect world, at least in this rate environment, SoFi wants their money in personal loans. It's where the big money is right now, and bringing in a lot more deposits. And no one's really talking about that either. Like, I don't know. There's just if we're able to sell loans, even the bearish things that Anthony Noto and Chris Lapointe spoke about on their last quarter, like only 50% of revenue is going to be from lending, that will be gone in the dust. They will bring on so many new originations because they'll be able to turn over their loan book multiple times. SoFi used to turn over their loan book 4 times a year. Okay. Now we're selling in a year like a couple percent points on our entire book. Imagine if we can now flip a multi-billion-dollar book multiple times. The real gains there is incredible because the scale, since we've become a bank, like we're in completely different numbers now.
And think about
that's
where
on
they
top.
can reinvest that capital into other business units and other areas. Like it's just, this is something,
and that's on top of them growing their book value.
I don't know why people don't believe Noto. Why do people not believe Noto? He says, I'm going to go where there's the biggest return on capital because that's my responsibility to my shareholders. And I'm a really smart guy. They're like, well, you can't sell the loans. So no, we're just making 2 points more. And when it becomes more profitable to sell the loans, they're going to sell the loans.
Yeah, I mean, that's a good point. Back in Q2, that was the big argument. He came out on the conference call and he said, my obligation is to generate the most return for the shareholders. And if we decide to hold them on the book because we get a bigger spread versus selling them, that's what we're going to do. And then we will sell them in an environment where it is opportunistic to do so. And they showed last quarter that it was an opportunity to do so. I mean, people can hate this company for whatever reason. You can't stop them. That's fine. But there are too many pros versus the cons for me, because what's the downside at this point? Obviously, anything can go to zero and any business can go under. Okay. That can happen. But are student loans getting frozen again anytime soon? The possibility of that is so slim at this point. The Fed came out and said they're at the top of the cycle. Even if they do shock the market in January and go up by 25 bips, because you have to agree that that is a possibility, because they came out and said they're leaving the door open if the data says to do it. That doesn't mean that they're not going to cut in March or June, but at some point in 2024, they're expecting to cut. So you're at that top of the cycle. The only way to go is down when you look on the next year to the end of 2024. So where is the business environment that's going to hurt SoFi? Because when rates come down, people are going to be able to get credit cards at a lower rate. They'll move over the debt with higher limit and pay off that existing card. They'll be in a better position. Cost of capital will be lower. and it'll be a volume game for SoFi. And as rates come down, all the other banks, their CDs are going to come down. Whatever they've been doing to juice the savings accounts is going to come down. And SoFi will also come down, but at a much slower pace because they are in one of the best, if not the best position to keep rates higher for longer. So
yeah. And
show me where I'm missing here.
One thing I'll add to that is that for as long as SoFi's primary business driver from a revenue perspective is their lending segment, all analysts are going to hyper focus on the macro environment for rates. And the frequency of how often SoFi can turn over their loan book is going to be a function of how quickly rates can fall. And so all analysts, they're going to hyper fixate on what the Fed is doing at any given point in time to then extrapolate and say or predict what SoFi is going to do for as long as lending is their primary business driver. But as we get technology platform ramped up more, and as we get financial services both contributing to approximately 50% of the revenue mix, then you're going to have a higher detachment of the macro versus the SoFi specific fundamentals.
Yeah, I mean, look at some of these comments and look at Tesla. I still don't agree with the valuation, yet I started buying for a very specific reason. But Tesla's a perfect example because you had so many people, including myself, who thought the valuation was absolutely crazy. And the stock kept going up. Like SoFi can be an anomaly in that area. I'm not saying it is because I don't think it is. But I'm just saying that even if the majority of people think it's wrong, it can still go up. Look at Tesla. I mean, how many people thought it was overvalued the entire way up, yet it just kept defying the odds? Like these things can happen.
That's
doesn't
true.
matter what any of us think. The market's going to do what the market's going to do.
But to your earlier point, I don't think there is anything. You're not missing anything. There is nothing that's going to bring SoFi to zero. Tesla could have gone bankrupt when they were shorting. I mean, there was really a possibility before when they were having all the problems with the Model 3. I knew a lot of people who work at Tesla. I still know a lot of people who work for Tesla. And that company was on the ropes. Like there's no rate environment or regulatory move that's going to put SoFi out of business. It's all going to be transient, medium term, maybe put some pressure on them for a couple of quarters. But SoFi is not going bankrupt. Their balance sheet is not weak. They're not buried in debt. And they can shore up their balance sheet any number of ways. What if they have to sell some loans for less than an ideal return? I mean, if they were under pressure, it's not like they're going to go to zero and they don't have options.
Yeah, there's one more thing I want to say, and then we can pivot onto something else. It's a year later. Everybody is aged a year, okay? Time is on our side. That's a good thing because you know what that means? More people are in college. More high school students are getting closer to graduation. More high school kids are going to be going to college. What does that mean? Well, for anybody who wasn't working during high school, they're going to need to open up a bank account if they don't already have one. It means that they're going to need to get a credit card. It means that they're going to need student loans. It means they're going to need financial services. And this is SoFi's market. Every year that goes by makes SoFi stronger because SoFi is targeting the younger demographic. They're not targeting me. I am outside of their demographic. And that generation is continuing to make more money. And they're the generation that is going to need personal loans. They're the generation that's going to need a mortgage because they're the ones that are going through those life expectancies for events. And not saying that other generations aren't, they are, but statistically, the younger generation is always at a higher need because they're going to have graduations or student debt or get married or need a loan for something more than other people. So you have a built-in environment for more members and more financial services being utilized as the years progress. Like this is a great setup for us.
It's
one thing.
SoFi's about to explode. Let's just come out and say it. I mean,
yeah,
I'm not saying. I think SoFi's set up. This company could catch fire. I mean, I know everybody's saying 19%, but this thing could be a runner, as Steve said. I mean, Tesla ran for no reason. There was no multiples that justify that valuation.
I mean, look at the short interest.
That's exactly it, Danny.
Sentiment.
Let me just bring it back. Tesla, one of the reasons why it ran for no reason was because of how the market viewed that company in terms of what was the multiple that they applied to that company as a tech company. A lot of the legacy people were saying, oh no, it's automotive, it shouldn't justify this price. But with regards to SoFi, I think if we bring it back and we talk thematically, every year has been a thematic building block for them to achieve this growth of where they are. 2020 was a lot of their core products coming to line. 2021 and 2022, the bank charter, and they actually had that backing from that financial perspective. They also started, Technisys in 2022, moving everything in-house from a technology platform and building on that in 2023 with regards to even the lending side. 2024, I think, is going to be, thematically speaking, the year where we start to see a hybrid valuation for SoFi as a result of their other business lines picking up steam. And one thing that this KBW analyst totally discounts, assigns a big fat zero to, is the technology platform. And the technology platform in itself is going to be the start of a ramp in SoFi's shift of the revenue mix. And that is going to be the catalyst to apply a hybrid valuation model to SoFi. And when we get that, the market is totally going to see this company in a different light.
And he explicitly said on the call, technology revenue will be under pressure. The opposite of what Noto's been saying, and he didn't provide any rationale for that because nobody outside of the company knows what's going on with these RFPs. It's certainly not the guy from KBW. It's totally opaque. None of us have any idea what accounts Galileo is going to land. And I believe Noto, I don't believe he's going to set unrealistic expectations. Guy's like $60 million worth of the stock. He has more skin in the game than anybody but that snake mammoth.
Yeah. I wanted to add, he doesn't have a zero price target on the tech platform. I think Michael Perito had a $1.8 billion price on the tech platform as part of the valuation, which just rubs salt in the wounds of the idea that he thinks that the banking platform is going to be that bad. And especially whenever rates cut. One thing we also didn't talk about, and I apologize that the Wi-Fi here isn't great. The one thing that we didn't talk about as well is that, Steve, remind us what happens as rates come down. Where does market flow if not from fixed income, potentially more risk on into markets if rates go down enough? I think another thing that Mike might be discounting enough is just people wanting more exposure to fintech companies. If they can't get great rates through treasuries, then that's going to artificially boost up the market price, right? Increase multiples on stocks. That's going to make it even harder for the $6.50 price target to be the reality.
Yeah, catch up trade.
Yeah.
A lot of cash on the
sideline. Screen real quick. Since Tevis was talking about the technology platform, I don't know why the bar on the average member deposits is not there, but that's not what I wanted to show. I mean, you look at how the revenue from their three segments has grown, okay? And then you look at the contribution.
Danny, can you mute, by the way?
What?
I think someone's making tea right now.
No, I live in an older building in New York.
It's not me. City. I'd be making espresso.
I have steam heat, so it's fucking annoying.
Go ahead, Steve.
Contribution profit is finally profitable in financial services, and it's growing more in the technology platform, and we haven't even gotten started with the banking platform. And let's be honest, SoFi is probably the only one of these companies that has the ability to be the AWS of fintech through banking as a service platform. I mean, you tell me, you go find another company that is set up to capture banking as a service. I haven't seen any, and I look all the time. And these numbers could drastically change over the next year or two as they start to take market share and as they start to onboard customers. This could drastically change. And if that does, it should give them a hybrid valuation like Tevis is saying.
I've searched for a software company that competes with Galileo and also has a bank charter. and it doesn't exist. There isn't
a way to put it. Do we want to, just because we have 10 minutes left in the show, pivot to the other, I guess, biggest piece of news this week, the 2% IRA match promotion? Tanner, we want to talk about that at all?
We can. I'd be more interested in your gut. Like,
do you
guys have large opinions on that? Because
no, unless we have anything else to talk about, is my point.
Great for customers. It's great. It's great for SoFi members. I mean, it's not a big headline. It's nothing like, I mean, I just had a thought, guys. I'm sorry, but can you imagine, to what Steve was talking about, that they didn't warn? The stock just went down 20% because an unknown guy lowered this target by $1. Could you imagine what's going to happen to the stock if they don't report a net profit? I mean, I think the stock's going to get cut in half.
Yeah,
I would agree. I think 5's a real possibility of that.
Yeah, I don't think there's any chance they don't. I think Noto has a rabbit. I think he put all the garbage, the write down into Q3. I think the EPS might be a little bit better. I think Noto has this evil grin, and he's just not quite as safe and boring. I don't think he's just had this whole time with them shorting the stock, and I think this CR could be a little bit better than people think.
My fear around that, Danny, is that it's been so forecasted and so talked about and so foreshadowed by management that it is priced to perfection. And the only incremental alpha that we would probably get that would see an outperformance in the stock movement would be, in my opinion, the full year 2024 guidance that they provide being more bullish than forecasts, because profitability is such a expected piece of news, such a known that it could even be a sell the news type of event. And so I think that they have something in addition to profitability, where profitability is like the appetizer, and then on the call they talk about that guidance of how 2024 is going to be to keep everybody more enticed.
Yeah, nobody's going to consider a GAAP net profit a beat. I mean, that's just meeting the expectation that management's been setting out for 3 quarters.
Exactly.
So they have to do that. They've been promising it for a long time. So I think it's almost like 99%. But I don't think you sell the news from 8, though. I mean, I think you could have sold the news from 11, but I don't think you sell the news from 8.
What's the average analyst expectation for EPS for next quarter?
I actually got it up. I was looking myself,
because I don't even know if it is profitable. It might even be negative a penny.
I think it is.
Let me see. Can you zoom in? It's very small on my screen.
So upcoming quarter is GAAP estimate of a penny.
Oh, okay. Positive.
Positive a penny. Okay, yeah.
I'm looking for 5 cents.
What is a penny? Is that like 6 million? What does that even translate to in terms of the actual bottom line?
Let's see how many shares are.
It's like roughly a billion.
Yeah, there's roughly 1 billion shares.
So that would
just
be
under 1 billion shares.
Penny would be 1/100th.
Less than 10 million?
Yeah, it would be basically breaking even. I mean, pretty much. Yeah.
I don't know if I like this. This is on quarterly. Hold on. What's the annual? So there's not even much annualized projections out there. Just 2024 of 6 cents.
Yeah.
I mean, that seems low. If they're going to be profitable this quarter and every profitable going forward.
19. They're calling for
16 analysts. That's not like 1 or 2 analysts. That's 16 analysts.
Yeah.
Are saying that there's an average of 6 cents EPS for 2024.
But none of them have done any work.
It's full year. Go. I still haven't shared. Bring it back up. Look at this.
Man, I didn't know that.
These analysts on SoFi are flimsy.
6 cents, 16 analysts, December 2024.
All right, so just consider it this way, guys. We're expecting to be EPS profitable of a penny, right? 0.01. And full year analyst consensus is 6 cents full year.
For next year.
Now, Our good friend Michael Perito thinks that we're going to go below analyst estimates of 6 cents for the full year of 2024
by about 17%. So he's probably saying somewhere along the lines of 5 cents, something like that. Yeah.
These guys just like disconnect EBITDA and profit. It's just math. It's connected.
So I didn't read the report. Did he put an analysis in there of how they lose money?
No, not really. He didn't say they're going to lose money. He just said it's going to be 10 to 15% below analysts' expectations in EBITDA, which are hard to discern because none of the analysts for SoFi do any traditional work that you see analysts that cover like Chase or something. They project out 3 years. There's all these numbers. Most SoFi analysts don't even do any projections. They pull things from the nether regions. I mean, I don't think that many of these analysts are doing multi-year projections that are serious.
I want to see the quarter. I want to see what their guidance for 2024 is. And that's going to be the telltale because, look, this is a company that has a very good track record of not just beating, but beating and raising guidance. So let's see where they establish the baseline for 2024 at. And that'll give us a pretty good beat on the year.
And then you can add like 10 to 15% for sandbagging. You know, they always, because he's going to continue to raise, you know, every quarter. So you have to figure his projections are going to be 10 to 15% low rather than 10 to 15% high. And his projections are a little bit above the street usually, or at least equal. So I don't know, Perito, just that math on EBITDA, I don't see how he gets there.
It doesn't make sense. And if we're being intellectually honest with each other, the intended effect was just a short-term hit on the stock price.
Period. That's what I thought, but I don't know. I don't know. But it just seemed like, how did that was all teed up. That was all ready to go.
I do feel like that was
hedge fund guys are on vacation.
I usually don't see moves like that. I don't like to say that there's. Yeah, the stock price was really surprising from a single report that didn't add new clarity to the stock. That was weird, like for such a large drawdown. And then what was funny was the drawdown happened before the actual Fed minutes that happened later on that day. And that actually I found was giving real bearish signs a little bit because they were talking about how rates could potentially be higher for longer. Those are real concerns, but the stock had already drew down over 13% before those minutes. So people had already made their mind up.
Higher for longer is bad for SoFi. Lower is not bad for SoFi.
Maybe the meeting notes were leaked or something, but I think it's less about that report than anything because that just seems silly to me.
I mean, higher for longer, think about it. Higher for longer was this year, okay? We still had increases in the first half of the year. We had a regional banking crisis. You had 3 or 4 regionals that failed, and rates stayed higher for longer, and SoFi still thrived and grew revenue, grew EBITDA, and is moving forward toward profitability. Even if it's higher for longer in 2024, higher for longer in 2024 does not mean the same thing as it did in 2023. Higher for longer in 2024 means you dumbasses aren't listening to us and we're not cutting in March, we're cutting in June or July. Like that's what higher for longer means in 2024.
So I want to share something.
Do well no matter what happens. That's their business model. That's their management.
Yeah, unless something drastically goes wrong, I don't see how we don't.
SoFi has built a better mousetrap, and nobody wants to acknowledge that.
Agreed.
Can I share with you guys some numbers from the last time we saw Q4?
Is it from Koyfin?
No, it's not. It's directly from SoFi. So I just looked up the last time we saw Q4. What we ended up seeing was that they showed net income would be, and this is for projections for 2023. Okay. They said anywhere between 1.9 billion and $2 billion. Okay. And then by Q3 of 2023, they said the actual projection would be somewhere along the lines of 2.04 billion to 2.065 billion. Okay. Somewhere in that range. So we've completely increased the ranges on both the low and high end just by a little bit. Now look at the adjusted EBITDA side, the actual side of of SoFi's profitability. And I believe that this will be the same idea for net income as well. I wouldn't even listen to the estimates immediately for Q4, because this is what they did last year. In Q4 2022, they said 2023 estimates were going to be $260 million to $280 million. Today, they said for the full year 2024, we believe it'll come in at about $386 million to $396 million. So from 270 to 390, an increase of about $120 million, a 5% increase in EBITDA alone. And that was a matter of 3 quarters. 3 quarters that they've changed those estimates. So almost imagine what's going to happen come January 29th, all the way through by the end of the year. So guidance is one thing. The sandbag is absolutely real at SoFi, though.
Yeah. Noto knows this game. I mean, Noto is a master puppeteer. The guy's so polished. You just couldn't think of a guy who's better sort of suited to take banking into this next century and run with it. I mean, he knows this game. He's winning. He's just cleaning the clocks of these big banks. And again, we're just such a nothing burger. Everybody's talking about growth has to slow because the company's getting so big. We're still tiny. We still have a 0 share of the financial services market. There's no reason SoFi can't keep growing at 30%. We're going to grow the top line at 35%. I think we're going to grow the top line again over 30%. I think we're going to have a much better 2024 than we had a 2023, and 2023 was absolutely fantastic. I don't know what these guys are talking about. I don't see the weakness at SoFi. I don't see it. It's made up.
That's
run on made up.
That's what management said, right? They said what was it? We have all the headwinds behind us. It's now tailwinds or becoming tailwinds. And that the only thing holding us back from 20 million members is just brand awareness. So we have all the tools. It's just a matter of time and execution. And so far, that hasn't proven the case that they have faltered on either one of those goals. So
given the challenges, their execution has been better than perfect. They get no credit. They get no respect. This company's killing it. Management's killing it. The guy's absolutely out of his freaking mind. What he's saying doesn't make any sense. It's not credible. That's my opinion. I'm not saying he's not being honest, but I'm saying if that's his opinion, it doesn't jive with Michael Perito 6 months ago. It doesn't jive with Michael Perito 2 years ago. He sees a company that's basically fallen apart, and the company's only getting better in reality. So I don't know. You're just not entitled to your own facts. You're entitled to your own opinion. But the bearish analysts never cite any numbers. They never go to the ER. They never talk about deposit growth. They never talk about how SoFi is able to capture such a high percentage of direct deposits. SoFi is doing things that if you look closely, other banks are not doing. And when you get customers that are direct depositing into your bank, they're not leaving. Statistics bear that out. People do not want to leave their bank. They uprooted their lives to move to SoFi, and they're direct depositing tons of money, which is driving growth at SoFi, allowing SoFi to make loans. And it's only gaining steam. It's a snowball going downhill. And I just think these analysts are fighting with objective reality for these bearish calls because they're just trying to rescue people that shorted the stock heavily from 720. And they just don't have a leg to stand on. So they have to just construct this to try to that's what I see. I don't see any other explanation, but
well, like you just said, there's still big short interest, around 15%.
Yeah.
So look, what happens when they beat earnings? Let's say this goes down again. How much more short interest are they going back to 20%? Like at what point do these shorts start to cover? Like what's that magic number got to be for them to start to cover? And then at what point does that covering really drive this higher? Because it sure as hell seemed like shorts were covering last week when it ran, and now it just dumped again. I mean, it's just at some point things are going to go right.
No shorts covered Tuesday, Wednesday, or Thursday. There was no covering. They were only churning and accumulating, and I don't think they're stopping that many people out. I don't think there's that many weak hands left in the stock.
I think that this gets a lot harder for the shorts when SoFi reports profitability. because that has to blow up a lot of the bear thesis, because it's no longer guesswork if they are or if they're not. And then if guidance comes out strong, this could be the quarter that it may not sell off after earnings, because there's much more risk of staying short.
Yeah. And at least we'll have an EPS multiple. I remember, the bologna sandwich, when he was putting out his FUD $4 call, he was saying, well, the SoFi, it's like the analysts that are bearish on the stock always look forward, never cite statistics. The analysts that you see, Jeffries, and they go to the ER, they go to the statistics. Steve, you guys, you go to the numbers. I don't see any of the bearish analysts citing real statistics. And if you look into his call on technology, there's no substance to it. And his EBITDA call, there's no math that makes any sense. There's no substance to the call, and he crashed the stock 20%. I don't know how he did it, but it's amazing. Like that guy, combined with the media, has that kind of power to me.
Look, Scary. Go down more. I'll just keep buying. Have fun.
Steve's not. Look, it's not. You're not going to hurt Steve. I mean,
Noto said there will be an acceleration in Galileo in Q4. It'll be quickly evident whether there should be a premium for this platform or not. But that's on earnings come January 29th at 8 a.m. Eastern Standard Time. So hopefully, Danny, you're more than welcome to join us. Roy's more than welcome to join us. Chris Hager, whoever is part of the SoFi community, we welcome you guys to join us. Steven is welcome as well. He usually can't make it that early, though. Make sure you guys come back. Make sure you guys hit the subscribe button so then you guys can see whenever we are live. We do this every week. But aside from that, really do appreciate all your guys' time. We're going to wrap there. And for all the members out there, it's usually a SoFi after hours. So look out for that as well. But appreciate you guys all. Anything else? Any last words? Any hi moms or something like that?
Happy New Year, everybody. Health and happiness. Don't set stop losses.
Happy New Year, guys.
Don't set stop losses, and don't dump on FUD.
Don't invest just because we're bullish.
Don't listen to me.
All right.
Don't listen
Bye.
to Danny Deals ever.